Formal discussion with Ryan from Merkle Capital. I was having a discussion with Ryan just about our approach at Cadro Capital Partners. When we get new clients in, we often use a dollar cost averaging approach. What we're trying to do there is not try and time the entry when we're putting money into the market, but trying to mitigate that risk of mistiming. So if the market falls after we've entered, then we're putting in capital subsequently. I thought it'd be interesting just to have a look at what that'd look like from a Bitcoin or from a digital asset perspective. So I put it to Ryan just to do some data based on data analysis based on historical periods. Ryan's done that and he's here today to present on his findings. Before we proceed though, I just want to let you know this is a general discussion. There is no personal advice given in the presentation. If there is anything that you'd like to know, please speak with a licensed financial advisor or a tax agent. So Ryan, do you want to just set up the situation? Because I know we're getting clients calling saying, are we at the bottom? Is it the best time to buy now? When should I start investing into digital assets?
Thanks, Gabe. Yeah, I'm starting to get a bunch of those questions too. You know, are we at the bottom? And I think, you know what, we're somewhere around the bottom, and that's where DCA really starts to make a lot of sense. You know, you want to get a piece of the bottom, but you don't have to get all of it. We had this discussion in our IC recently, and it really is about, you know, stepping back, not being emotional, saying, you know, that's the bottom, you know, or really having to be really predictive, because that is really uncertain, really difficult. The bottom usually comes at a moment of peak fear when people are looking to sell rather than buy. So stepping back and using a DCA approach, which is, you know, I'm going to have this regimented way to get access to the market and sticking to it, it works really well, particularly with a volatile asset class like this. So the data we looked at is starting your entry point around now. So that's 8 months from the cycle high. So we've gone to look back at previous cycles. 8 months after their cycle high, we've started to buy. So $10,000 deployed on the first of each month, with not even looking at the price, just saying first of the month buy. You're not trying to time your entry at all. Doing that for 6 months, so putting 60,000 into the market, and we're going to look at the returns and results of that simple, really simple strategy.
No, thanks, Ryan. So I think we all know that acronym about trying to pick the bottom. What you're saying is don't worry about that, but put a plan in place. So one of the traders' comments is always plan your trades and then trade the plan. Take the emotion out of it. What you're setting up here is an averaging in without emotion. So you're saying now we're about 8 months in from the all-time high, is that right?
Yeah, that's right. So that was October last year. We're about 8 months now on from that. We've had this really nasty correction. So we're clearly right in the middle of a bear market. Looking, there's some seeds of recovery at the moment. I think the bottom's already in, but you know, historically, they've taken a few more months to play out. But either way, bottom in, not bottom in, doesn't really matter. Now is the time to get in when you've got these discounts.
Right. All right. Let's show us what you found.
Sure. So here we are back in the 2018 bear market. Halfway through it here, prices around $7,000 in August. Slowly trends down to 3,800. That was pretty much the bottom, very close to it. Your average entry then is 5,500. You're actually down on the capital that you've put in, but that is the DCA strategy actually working, because you're getting cheaper and cheaper entries. Maybe price had to take it off and it's gone the other way. You've still got into the market and got some exposure, and you continue to build it. This is it working as price goes down. So how does that look through the rest of the cycle? Really, really impressive. So for this cycle, the high came in November 21, 69,000. Your 60,000 would have been worth 740,000. That's 1,100% return. So that's pretty healthy, no doubt. Even then, when you go through to the cycle low, after that, 15,600, you're still sitting on 180% return profit. So it's worked really well because you've got your good entries. You haven't come into the market late and sort of bought with a bit of FOMO. You've bought a really disciplined way early in the process when the market's cheap. That's right. You know, like buy low, sell high. In this case, we're just trying to buy low. That is it. Really simple.
So Ryan, it looks like you haven't cherry-picked dates there. You've just gone the first of each month?
Exactly. Yep.
Yeah. And then what we're saying is the 4-year halving cycle, that creates this phenomenon, isn't it? It's not anything other than the 4-year halving cycle associated with the rewards for mining.
Yeah, that's right. So that has historically given these really clear 4-year cycles that you can sort of plan around, and give you some confidence as to what's going to happen in the future. We've only had 4 of these cycles, 3 the proper ones that we really monitor that are more modern. So not a huge sample size, but it is enough and has been consistent that we think it's worth following. The trend is your friend until it's broken. So we think that continues until it doesn't.
Right. So we've had another cycle. Let's see how it played out there.
Sure. So 2022 cycle. This was around, late into this cycle would have been FTX blowing up. Prior to that, we had Three Arrows Capital and Luna blowing up. So prices are pretty depressed. You're getting really great entries each time, 8 months in to the bear market, around the 20,000 mark. All really good entries. You'd be really happy with those. Price did bounce around a little bit. Again, you're underwater at the end of that process, but you have pretty much finished up at the very end of the bear market. Those $20,000 buy entries, when price at the end of the cycle is 126,000, you're up 500%. Even at February's low, at the bottom of that most recent bear, the current bear market, you're still up 204%. Really powerful way, really simple. Take the emotion out and just buy. People are probably screaming at you to sell around this 16,000 mark, and that's the tricky thing. That's why you can't pile all in at that stage. But if you're buying cheaper than you did last month, it feels good, and that's how DCA works.
There really is an unemotional strategy. It's just put in the same amount 6 times, basically from today, but this is the historical outcome. You're looking at 200 to 500% return.
Yeah, really easy. That's right.
It's incredible, isn't it?
Get the volatility on your side when you're buying low, and then you can ride the wave. So let's have a quick look at that on a chart as well for people to sort of get another visual of. Here are the recent cycles. So we've got bear markets in red, and we've got the bull markets in the green. Here we are in the middle. These circles are what we're suggesting. This is what the data is saying, buying this zone, and now we're getting into that buy zone again. So nice and simple. Take the emotion out, just start buying at the moment, and we think that strategy will hold up again really well.
It's very stark, isn't it? It looks like so what you're saying is at each period you've started at exactly the same time as now from the all-time high, and that's how you've got your 200 to 500% return last time and that 1,200% outperformance or total return.
Exactly. Yep. It's worth noting we're only talking about Bitcoin here. If you were to overlay some other majors like Ethereum and Solana, those returns are even bigger. There's more volatility, but there's more upside, and that's ultimately what we're trying to capture at Merkle Capital as well. But what we really don't want people to do is to wait for the market to move and sort of get their entries here late into a bull market. Then you've got to wear all of this pain, and you've got to wait 3-4 years till you're really sitting on some decent profit. And so that's what we don't want people to do. You're not trying to buy high, you're trying to buy low, and the strategy really works.
But I think what's interesting on this is it really does show you that old adage, it's time in the market, not trying to time the market. So another thing that we talk about is volatility or risk is your friend. And by that, I mean a market that's moving up and down is fine as long as you don't have to realize that risk at the wrong time. And what I'm seeing here is if you bought early and just kept holding through, so you never sell, you're getting a really good performance. So show me, Ron, what would it have been if you did DCA in 2018? Where would you be at now at this low point from a returns perspective?
Yeah, so from that great entry, you're up 2,000%. I think that's a good way to look at it. You're not looking to sell necessarily. You've got these. Finding the top is really hard as well. I know it is on these 4-year cycles, but at each of these tops, it's really difficult. That's what we're trying to do. But the easy part really is buying deep into this bear market. All you do is buy in here, buy in here, buy in here. You're a long-term holder. You're not really looking to trade and sell out. It's just not worth it. The risk return isn't there. You're going to get it wrong. Just buy fundamentally on this. Nice and simple. Anyone can do it, and you can get some really amazing returns.
So we're saying 2,000% over an 8-year period.
Exactly. Yeah.
Jeez. I don't know if you know that the rule of 72. It's how long does it take to double? And you say 10%. Oh, it'll double every 7 years. 7% return. It doubles every 10. 2,000%. I think you're doing quite well.
and it takes that volatility out. When you're up that sort of amount, a 50% drawdown is a bit of a shrug of a shoulder. In fact, it's like, oh, I should start looking to add to my position now. I know how to play this game now. When the market starts to sell off, okay, I'll give it a little bit of time to get into its process, and then right now's the time you start stacking. And we're seeing the whales do that again. They've done that throughout the cycle, and are starting again. So get on the smart money effectively. Lean into that volatility and fear, and that's where it makes the whole rest of the journey so much easier.
Well, thanks very much, Ryan. That was very insightful. I think it's a great opportunity to dollar cost average. So we're looking at right now 8 months from the all-time high. Historically, it shows you're getting 2 to 1,200% returns over one cycle. If you just average in over 6 months, keep it pretty straight trading plan, and then you're saying 2,000% if you held for the 8-year period. Greatly appreciated, Ryan. Is there anything you wanted to close off with?
No, that's all. Great to chat, Gabe.
Thanks very much, Ryan.
Thanks,
Take
everyone.
care, guys. And please, if you've got any questions, I know Dean and Ryan are only too happy to answer those questions at any time. Thanks.